everyone. I'm very pleased to welcome today Sophie ELKRIEF, Fund Manager at Dexia Asset Management. She was here last February to talk about the prospects regarding mergers and acquisitions during the year 2010. She predicted a very promising year for these kinds of operations. So let's see what happened and if she was right. Hello, Sophie, and welcome back.
Thank you, Asha. Good morning.
So did the market finally behave according to expectations?
Not especially. I mean, there are good stuff and bad stuff. And we had two scenarios last February. I mean, a good one with the bullish one, with a rebound of volumes in terms of mergers and acquisition as soon as the first quarter of 2010,
right?
Because of good credit condition and so on.
Unfortunately, it didn't happen.
Unfortunately, it didn't happen. And why that? Because we had a lack of confidence in the market, which is absolutely necessary for managers to go out and buy companies.
And that was due to the sovereign debt crisis, right?
Exactly, that's right. And so the sovereign debt crisis really kept our market, very, very quiet during the first half of the year. So we had a couple of opportunities in the US especially, but in Europe not many, and overall really disappointing volumes.
So how do you explain the market behavior during this summer?
The summer was good, first in terms of rebound of volumes on mergers and acquisitions, and overall equity markets were a bit better
right,
than
there was
expected.
a return of confidence.
Exactly. And this return of confidence, at least this is my explanation, would come from, the first point is that we had a sovereign debt crisis, and we had political response to that. So in terms of market sentiment, at least it's less unexpected.
Right.
At least you know how you can respond to such a crisis. It's not new, and you know that the market hates new stuff. The second explanation might be the fact that we had uncertainties in terms of macroeconomy. And do we expect a double dip in the US?
What about that? Is it a threat or not?
It's still a threat,
right.
To tell you the truth. But the more economic data we have, you see that they are not exceptional, but they are not terrible as well.
Okay.
So you know that you're going to have a slowdown in the US. The growth will be less compelling than expected. But it's but you know. So you're just not in the dark, double dip, not double dip. It's less compelling, but still you have some growth.
So why would a scenario of slow growth be favorable for you?
Slow growth means lower organic growth, especially in developed countries, so in main markets for the US and European companies. But at some point you need to deliver growth and top-line growth because cost cuttings have been done in the past 2 years, so your margins have resisted. But now, you need to keep up the pace.
Right. You mean companies cannot bet on organic growth, so they are thinking about external growth.
Exactly. And so slow growth environment, that's our belief, will be even more favorable for external growth.
On which sectors do we need to focus?
We need to focus on sectors where people are rich, so when they have cash.
There are lots of cash.
Yeah, and truly companies have a lot of cash. I think the US... Overall, U.S. companies of the S&P 500 have almost $1,000 billion of excess cash, which is huge. So the sectors that are the most cash-rich are technology companies. So they have cash, they have uncertainties on their business models, so they're buying companies. So you see, we saw a lot of transactions in the security business, for the cloud computing business, and so on. You have pharmaceutical companies, they have a lot of cash, but they still have a lot of uncertainties in terms of patent expiration, generics, so they buy biotech companies, they buy network in emerging markets. Again,
still lots of opportunities.
I think there are a lot of opportunities. I talk about those two sectors, but if you take the material company, the basic material company, it's cyclical, but they have tons of cash, and they're buying projects, and they have good prospects. And look at the announcement of BHP Billiton offering to buy Potash Corp. It's a $40 billion transaction.
Do you have any specific solution regarding mergers and acquisitions?
We have two products to offer. Of course, those products are both UCITS 3, AMF regulated. We have one which is a low volatility and very focused on announced mergers and acquisition, and this one has an objective of EURIBOR plus 200 basis points. And the other one is medium volatility with no leverage, of course. I mean, that's the branding of our firm. And the objective is around 500, 600 basis points above EURIBOR.
Do you think that the goals that you have set for the year are achievable?
Truly, I think they are. If the rebound in terms of mergers and acquisitions...
You mean if the markets behave properly, it should happen?
It should happen.
What if it's not the case?
I think that the good news about our product, you're going to have a decent performance, yielding, a positive performance, yielding more than cash, but disappointing compared to the objectives, of course. But overall, the risk-reward remains very good at that point in time.
Which is a good thing.
Which is really a good thing.
Well, Sophie, thank you very much.
It's always a pleasure.
As you can see, the global M&A markets has reopened for business, and there are luckily some new investment opportunities. Thank you for your attention, and goodbye.